Welcome to the SNN Network Canada virtual event. I'd like to introduce our next presenter, Nick Blitterswyk, CEO, UGE International. Nick, the floor is yours.
Yeah, thanks so much, Kate. Good morning. And thanks to the crafts and everyone at SNN for putting on another great event here. So I'll run through the deck here. Just a reminder, of course, that you can submit questions. Already had a couple coming in, and I'll make sure that I go through the deck fairly quickly so we can have some good time for some Q&A at the end there. Hopefully everyone can see the screen. Just off the top here, as I flip through the first couple slides. So in terms of UGE, and just some highlights off the top, if you're not too familiar with the company, we're number one, a very fast-growing developer of community solar projects, and we'll talk more about what that means as we go through the presentation. But our backlog grew from about 17 megawatts at the beginning of last year to about 145 on our last press release in November. So we've been growing very rapidly in the fastest growing segment of the overall solar industry. Our business model is to develop long-term recurring revenues through the development and ownership of these projects, but it's a very, very capital light business model. So we'll talk more about that as well. But in essence, as we bring these projects together and they start to generate recurring revenue over a long period of time, we actually fully fund the CapEx of those projects through third-party sources. So we'll talk about that more as well. And then lastly, I started the company about 12 years ago, and through the 12 years, we have over 500 megawatts of experience across, at last count, about 750 projects. So we really know what we're doing in this space. We have names like T-Mobile and Bloomberg that we've just announced a contract with here in the last few months. And at the same time, I think that it's a very exciting period of time for the company based on the pivot that we made beginning of last year to owning and operating our assets as opposed to selling them like we used to. And so we really feel there's a lot of blue sky in front of us and a lot of shareholder gains to come as we execute on our business strategy here. Just on the top, we're traded on the TSX-V. We have very strong insider ownership at about 43% here. You see that we're fully diluted, about 37 million shares. Market cap on a fully diluted basis, just over 61 million or so. And we're based in Toronto and New York. So I'm Canadian, but started the company when I was down in New York, and the executive team is split about 50-50 between those two markets. Most of the projects that we develop are in the U.S. these days at over 90% of all that we do. Strong leadership team. Again, I've been with the company since the beginning. Robert and Tyler have both been with the company now for, I think, 7 or 8 years. And Stephanie joined us earlier this year as our CFO. So to talk a bit about the landscape here, many of you on the call would already be familiar with the fact that solar costs have become increasingly cheap over time. I still get asked the question from time to time about solar being expensive. Frankly speaking, it's not. The solar is already about 40-45% of all new energy capacity being built in the U.S., and that's projected to reach 80% of all new energy around the world by 2030. So in terms of the overall pie of energy capacity coming online, solar is really where the smart money is. In terms of the mid-scale space, so UGE, we focus on what would traditionally be thought of as C&I. So it's the space that's bigger than residential, smaller than utility scale. So this mid-scale space. Now, if I think very briefly about the last decade here, it used to be a market where C&I was cash deals from well-capitalized companies that wanted to do something that was environmentally friendly. As solar came down the cost curve, the power purchase agreement became the norm. This is solar on your rooftop, and you would buy energy from that finance system at a rate in line with or cheaper than the grid. But the problem with that is that 90-something% of C&I building stock is not owned by the tenant. So the tenants didn't have the ability to put solar on the rooftop to benefit from that cheaper energy, and the real estate owners didn't have a reason to allow for it to happen because they weren't the ones using the energy. What's happened in the last few years is a very quick movement towards community solar. So in essence, that's an industry term, and I think that it kind of downplays how big of an industry this is. What it really means is that we look to places where we can install projects and then put that energy into the grid to other energy users, which virtually off-take that energy or buy the credit that energy represents from those systems. So what that means is that we're really separating out where the projects are and who the buyers of that energy is. And so earlier I talked about 90-something% of CNI building stock not being owned by or not being occupied by the tenant. Now what it means is that all of that building stock is potentially good clients for UGE, and not only that, but then you also get into ground mount projects and things like that that also open up this mid-scale space. So this is the fastest growing segment of the overall solar industry right now. This map, if you look at our past investor presentations, it seems like another state gets colored in every month or two, especially up here in the Northeast where we are. Virtually all of the work that we do is in the kind of the broadly speaking Northeast region of the country, and we've seen ourselves grow, hitting our target to several new states this year. Just to drive this home, the Department of Energy came out with a goal a month or two ago for the community solar segment to grow to power 5 million homes by 2025, which represents about 8x growth. And as you can see, it's right in line with the sort of upper channel of where we see this market growing. You also can see that 2025 target is about 1.5 times the overall size of the residential market right now. And just to remind us, the leading company in the resi space currently has a market cap of close to $10 billion. This mid-scale space does not yet have a sunrun of the resi space, but of course UGE, we're looking to build ourselves to be just that, and excited for how fast this industry is growing. Within this mid-scale space, the way that we stand out, we are a full life cycle solution. So over the 12 years since I started the company, we built out the expertise to originate and develop our own projects, to execute the build out of them, to finance them, and own and operate. The most recent pivot has been to stop selling our projects and start holding on to them, financing them, and building up that long-term or very long-term recurring revenue that those generate. Within the market, it's still a very fragmented place. Where you see, like when we're out there in the market, it's typically the local developers that are just that left box that we're up against. We used to sell our projects to like the companies that finance and own and operate these types of projects. And there's a SPAC transaction, I believe, getting ready to happen on Friday, which is a fund that we used to sell projects to named Altus that is really just the right side of this. By being the full life cycle approach, we provide a much better service to the clients that we work with in terms of being the one party that they work with across the full life cycle. We also capture much higher returns by not needing to go out and buy these projects from other developers or what have you. And so we really feel that this makes us a lot more efficient and a much bigger winner in the long term in this industry here. As you can see here, number one is that since we made this pivot to owning and operating our assets, we have grown really, really rapidly. So from about 17 megawatts of backlog at the beginning of last year to right now it's in excess of 145 megawatts. So closing in on 10x growth in 2 years here. We had set a goal of 120 megawatts for this year, and we announced in our Q3 a couple weeks ago that we had already exceeded our goal for that for this year. That's on a broader pipeline, which is getting very close to a gigawatt now. As you can see here, this is the full breakdown, and in our quarterly MD&A, we provide a pretty thorough breakdown of how this works. I believe the pipeline, if I'm not mistaken, has grown something like 7x this year. We did a financing at the beginning of the year. We used that financing to grow origination and development teams in particular, and brought in a number of great people that have joined us in many cases from some of our competitors. And so we're really excited about how quickly we're growing and just simply how much opportunity there is out there in our industry right now. There's a few different ways to value the company and to value what we do. One of the measures that we talk about is this net value retained, which is really like the net that we're looking to earn out of these projects as we develop them and build them out and own and operate them. We give an example in our investor presentation, as you can see here, of the staircase to see how much value is generated as these projects are brought to fruition. So in this case here, which is based on the New York City example, it's 81 cents per watt. which means on a megawatt, that would be $810,000 of net value. On 100 megawatts, that'd be $81 million US of net retained value. And you get that through the different parts of this, what I earlier talked about as a fragmented industry. So our origination work, our development work, building out the project, and then the owning and operating of those projects over time as well. I will say that this is on a present value basis. So that 35 cents per watt that you see there from the project cash flows, that is discounted to the beginning of the operation of the project to get this net retained value measure. We do feel that this is important though, as we're out there adding projects to our backlog and then seeing those projects mature into operational status. We feel this is a really important metric for us to be tracking here in terms of what the company is worth. I will say that out there in the market, like for example, on the resi side of things, companies typically trade at a multiple of their net value. So it's, you know, and we're trading right now at a fraction of what our net value will be on that backlog that we're developing. In terms of how these projects come together, and this goes back to the capital light aspect of things that we talked about earlier. This is one example. Of course, there's a good number of numbers on here, but I'll talk about this in a somewhat more generic basis. Now, number one is, of course, UGE is the quarterback making this all happen. So in terms of our proprietary know-how, it is identifying good places to put projects. It's developing relationships with the real estate owners to lease that space over a long period of time to develop these projects. It's working with energy users like T-Mobile and Bloomberg and others to provide them with green energy, cheaper than the grid over that same long period of time. And then it's, of course, working with utilities to interconnect these projects, the towns to permit them, and so on. So UGE is really the quarterback that brings all of this together, and our return for doing so is the returns that our projects generate. Now, as we're developing these projects, of course, there's CapEx in terms of us going out there and buying the solar panels and other equipment and so on, and then there's our sources of capital. So when I talk about this being a capital light business, roughly speaking, let's say that there's $1 of CapEx on a project. What we'll do, and this is sort of rule of thumb, we'll bring in some project level debt. So this is senior to the project, non-recourse to UGE, the parent. That senior debt would be, you know, in this case, it's targeted at 4.5% over a 20-year amortization. And then there's also this investment tax credit. It's something that in the U.S., it's an incentive towards building energy projects. I talked about $1 of CapEx. That debt plus that tax equity comes out at more than $1 of CapEx. And the reason it comes out as more is because UGE is the full life cycle solution here, we're paying ourselves a developer fee that is net to our cash flow as we develop these projects. And then, of course, on top of that, we're generating the long-term recurring revenue and positive returns from these projects as well. Often get asked in terms of like, what's the IRR? Our IRR on a fully consolidated basis here is actually undefined, right? Because we're fully capitalizing these projects and really not needing to put any of our own equity in to start with or at all for these projects as well. But also we have our own internal hurdles to say, okay, we're going to earn a developer fee of at least, usually it's 10 to 20%. In this case, it's $600,000 on a project that would be worth, say, 4, so call it 15% of its fair market value. And then on top of us getting that developer fee, we're also looking to earn about a 9% post-tax unlevered IRR on these projects. Of course, we do have the leverage that we bring in. So that's a long-winded way of saying these returns are very strong versus the utility scale solar and what have you, and very capital light for the company as well. And I'll say that we do have another example in the deck on our website as well if you want to spend some more time on that. In terms of where the company is growing to, when we made that as well, we set a 2024 goal for the time that we cross 100 megawatts of operating assets. We set this goal at the beginning of this year. And at the same time, we're building our throughput in terms of how quickly we're developing additional projects. And we set a goal for building our team by 2024 to be able to add 100 megawatts of new projects each year as well. I will say that we're ahead of our targets. We, as of November 22nd, we're already at 145 megawatts of project backlog, and these typically have an 18 to 36 month build out in terms of time. So we feel we're in a good position to exceed that 2024 goal. And then not to mention, we have, I'll call it an outside chance of getting to 100 megawatt project development capacity this year. We're closing in on that as the year comes to a close. So we're feeling really good about how well we're executing as a company here. And then in addition, in terms of like EBITDA and thinking about the returns from these projects, for every 100 megawatts, as you see the bottom right there, and if you multiply by 100, each 100 megawatts provides about $50 to $100 million of this net retained value, and on an annual basis, we're currently projecting about that would be $15 to $18 million of portfolio or project EBITDA from each 100 megawatts. And I'll say again, like this is very long-term recurring revenue. As a baseline, it's typically 25 years. We often hold options to see that extended up to 40 or 45 years. So it gives us a long-term certainty as these projects come to fruition. I won't spend too much on the financial highlights, except to say a couple things. Of course, more information available on our website and on SEDAR. We're seeing right now the shift as the recurring revenue starts to grow. Of course, we didn't used to have recurring revenue because we used to sell our projects. And so we're starting to see that grow, and it's very, very high margin revenue. We typically talk about it as like 80% gross margin or better. It's actually so high gross margin that right now we don't actually show the offset there. But yeah, so it's very high margin long-term revenue. Also, we did a lot of work beginning of 2021 to clean up our balance sheet, and so we really feel like we're in a good financial position to really minimize dilution as we grow. And so especially with that asset base represented by our backlog and operational projects, we look forward to generating significant cash as the company continues to grow and operate more projects here. To knock up a few recent highlights, and then we'll get to the Q&A. Of course, we talked about the rapid pipeline and backlog growth and how much that's grown this year. It's at times a little bit hard to keep track of all of the announcements that we've had. We signed in August an 81-site LOI with a large real estate company that we're developing. That, as of our Q3s, was not in our backlog yet, but we're getting very close to seeing those projects drop into backlog as they migrate through the stages there. Number two is that on November 21st, we announced an entry into Massachusetts, and to start out with, we included over 100 megawatts of advanced stage pipeline of projects there that are typically solar plus storage and storage projects, which is also our first real foray into the distributed battery storage side of our sector as well. Talked a lot about our backlog already being well in advance of our goals for this year, and then the overall pipeline has also grown about 7x in the first 9 months of 2021. So we're really excited for how the company's growing here. Talked about T-Mobile and Bloomberg. These are big names, yes, but they're also really meaningful in terms of what that means for our business. Traditionally, community solar was sold to baskets of residential off-takers, but by kind of going around and working directly with some of these names, it decreases our customer acquisition costs. It gives us more bankability in terms of these long-term agreements and so on. So, we're excited for those agreements and bringing in others over time as well. And then lastly, I'd be remiss not to touch on the strong regulatory support that's out there right now. Of course, there was a bipartisan infrastructure bill passed recently. The Build Back Better Act is something we're still watching closely. Over the last few weeks, I feel like the temperature cooled a bit, at least in the capital markets on that. Our sources are still optimistic that the Senate passes this by Christmas. And there's a lot of incentive directed. The biggest piece of the Build Back Better Act is renewable energy, and that's really highlighted by a 10-year extension of the investment tax credit, upping the tax credit to 30%, including a direct pay provision, including incentives for low and moderate income communities where a lot of our community solar projects are based, etc. So we're watching that closely and optimistic about the chances there as well. And you know, just the last slide, just a highlight slide of things that we've already talked about. I know there's been some good questions coming in, so I'll flip over there now. But of course, lots of great experience for the company. We're in the fastest growing segment of the solar industry, this community solar segment. We have this massive pipeline and backlog that we continue to grow and develop. We really feel that we stand out in our industry based on the portfolio ownership strategy and the full life cycle approach to what we do. And this all comes together for us to be very well positioned for growth here. So any more questions, feel free to keep them coming. In no particular order here, one of them is the vision for the company for the next 12 months. I talked a lot about, and not to be patting ourselves on the back too much, but we've talked a lot about the growth that we've experienced this year. Beginning of this year, internally and externally, the message was we really want to capture more of this growing market. We're going to grow our origination team, and we're going to capture more market share and grow our backlog, and we've seen ourselves do just that. As we're closing in on the end of 2021, we're going to continue to do that, and I think our team is just as hungry for next year, if not more so than they were for this year. But we're also seeing many more of our projects get towards construction and then operational status. So we're excited to see that happening next year. So the end of next year, we're going to see our recurring revenue grow by a pretty high multiple versus where it's at right now, as more and more megawatts of projects get built out. And so I think when we're standing, hopefully at this conference at the end of next year, we'll be talking about our expectations for not getting to 100 megawatts, but probably a much loftier goal as a company continues to scale here. So, the vision is to be the leader in this mid-scale space, and really, really excited for the pieces we put together. The next two questions come along the lines of the backlog and when would it be constructed by. So earlier I mentioned 18 to 36 months. Our backlog contains both rooftop projects and ground mount projects. The ground mount projects tend to be a bit bigger, and so the majority of our backlog now is ground mount projects. Ground mount are sort of in that 18 to 36 month range. Rooftops can be a bit quicker, more like 9 to 18. If you look at the overall backlog, you might say, okay, an average then of maybe 2.5 years or something like that. So, as we're at the end of 2021 here, we're expecting that 145 that we announced November 22nd to largely be built out, into early 2024. So it kind of gives you a fair warning that we expect to be well in excess of our goals for 2024 as well. And then the other part of this question is the 719 megawatts in pipelines. This is pre-backlog pipeline, the historical conversion rates and so on. We've typically seen about a third of our pipeline convert into backlog. And one thing that we've said in the last couple of quarterly calls is that our pipeline more or less doubled from Q1 to Q2 and doubled again from Q2 to Q3. It's really indicative of the scaling up that we've had here of the company. So we expect again to continue to see pipeline drop down its backlog, and right now we're expecting it to be at that similar 30 to 33% type of conversion rate. So next question is, on the Q3 call, you mentioned that you expect to see cost reduction on solar going forward. Can you expand on that? There was a slide earlier in the deck that touched on that long-term, this was a levelized cost of energy curve, but you also could look at a solar panel cost curve, and you see those costs going down and to the right. Now, of course, this year there's been a lot of talk about supply chain disruptions and costs going up and so on, and so we've seen a little bit of a blip this year. I think it's not nearly what maybe some of the reports you've seen out there for the industry or other industries more generally, but we've been able to keep our capex within our earlier projections and so on. But going into next year, number one is that the solar panel industry added a historical amount of new capacity this year across the supply chain. So the supply equation for the industry is looking very good, and so that's going to help. I think on the shipping cost side of things, our take on this is that, things will normalize throughout 2022. There's no structural reason, in our opinion, that shipping costs should stay anywhere near so elevated. And then also just, the industry continues to get better economies of scale and efficiencies out of the equipment and so on. And so we expect that long-term solar cost curve to continue to go down to the right. I'd be remiss not to say that the Build Back Better Act does also have targeted incentives towards the manufacturing industry here in the U.S. for the solar industry. So we feel that is another very good reason why we should see costs coming down the cost curve as we you know what I'm saying, as we go through 2022 and onward from there. Next question, about 50 employees today, and is that sufficient to handle the upcoming growth, or would you expect that to grow too? We made quite a few additions the first half of this year as we bulked up the team, especially on the origination and development side of things, and we've got most of the right people in place. We're growing rapidly, and so we'll make some additions here and there as we grow. Some of those additions, I'll say, come specifically on like the deployment side of things as we build out projects, or the engineering side of things as we do as well. The reason I mention that is because those hit the cost of sales side of things as opposed to the SG&A side of things. But yeah, I think we really have a great team in place to be able to see this go from here, and so it's not going to be growing at the same rate going forward. Right, as of right now, there's one other question in here, although I'll keep my eye out in case any others come through, and that is on the storage side of things. Number one is that we have a portfolio in New York that we've been working on for some time, and so that has been something we've been working on already. The expansion to Massachusetts has a very good market right now for battery storage, and it's something that we've been looking to get more exposure in ourselves. We see it as part of the future here for the industry, and by 2025 expect all of our states to be good markets for the inclusion of battery storage. As of right now, like a megawatt of battery storage and a megawatt of solar, we're actually seeing a bit better returns on the battery storage side of things. But as a proxy and a conservative one at that, it's fair to assume that us adding megawatts of battery storage or solar plus storage is equivalent to us adding megawatts of solar as well. So with that, I don't see any questions right now, but appreciate all of you listening into the presentation today. We are always open to any questions. I'll just flip over to the next slide here. You see my email address right there. Also, Sophic Capital that we work with on the IR side. You can reach them at that email address there as well. So thanks again, and thanks for your interest in UGE. Oh, I might have had a question come in. Okay, so sorry. How many megawatts is within the 81 site LOI? I'll just say that right now that's in the pipeline. I don't have a number in front of me, but it's fair to say that we expect most of those sites to become real projects. And these are rooftop projects, which I mentioned happen to be a little bit on the smaller side. Like they're smaller than our ground mount projects on average, more like a megawatt per project. So if you look at that overall portfolio, and you can apply your own conservative, whether it's 2/3 or 3/4 or what have you, times a megawatt per site, you're probably in the right ballpark. So it's material, but as of the backlog we announced in November, none of those were in backlog yet. They were in pipeline. So with that, I'll say thanks again, and feel free to reach out anytime, and definitely appreciate your interest in UGE.